Okay. Hello, everybody. Welcome to Schoeneck King's webinar regarding economic development incentives for manufacturers. My name is Paul Reichel. I am a member here in our Syracuse office, co-chair of the tax group, also a public finance lawyer. Also presenting today will be Tom Simcoe, a colleague in our Albany office. Tom is a tax attorney and works quite a bit with tax credits. So today, we're going to talk about both state and local incentives for manufacturers. On the state incentive side, first I'll talk about the regional economic development councils and their award programs and consolidated funding application for CFA process. And then Tom will talk about the Excelsior Jobs program and those tax credits, and Brownfield program tax credits, and also other tax incentives. And then we'll circle back and I'll finish up talking about IDA benefits, Industrial Development Agency benefits that are available for projects, manufacturing and other projects, but with a focus on unique benefits that are available for manufacturers. Oops, sorry about that. Okay, starting out with regional economic development councils, or REDCs or REDCs. I don't know, people have different ways of referring to the acronym. So it's a relatively new program, the economic councils that started, I think, in 2010. There's 10 councils throughout the state. It's more of a local approach to allocating state resources. Each council has 20 or so members, usually leaders from the community, business, some municipal officials, perhaps academic leaders. And each region has its own plan that they try to implement over time. And however, manufacturing projects, just in general, are typically viewed favorably as being job creators. So if your particular project isn't in furtherance of your region's strategic plan, it doesn't necessarily mean that it's not going to be considered for assistance or benefits under the REDC program. But if it is in furtherance of the plan, it may have some additional priority. So here's a map of the councils. You can see where your particular region is located. And I'm familiar with the Central New York region. And here there's been a bit of an emphasis, particularly on downtown revitalization. And last year when the awards were made, there were quite a few grants for redevelopment of old buildings in downtown Syracuse, which has really started to bring the area back. So as I mentioned, each area will have its own different emphasis, but manufacturers are unique in their own way. Really the starting point, if you have a project, a capital investment or a need, would be to start with your own regional council. Later on, I'll provide the website address. And the process is starting now for 2019 awards. It actually starts in May, but the timing of this is very good. If you have a project on the drawing board, to start the conversation, investigate, and work with your local representatives from your regional council. So looking back, this is what was available going into 2018, into last year's process. The actual awards differed, but it was up front. This was what was available. And kind of a big picture. The direct assistance, I'm going to drill down on that, so I won't spend a lot of the time on that aspect of it. By the way, these resources are available not only for private businesses, but this funding also goes to municipalities, to not-for-profits, higher ed, economic development organizations. So it really is a large-scale program, not only for businesses. So there's quite a bit of money available, as you can see. However, not all of that would be directly available for manufacturers or other small businesses. the energy projects. Funding includes the Recharge New York program, which is low-cost power, which obviously for manufacturers can be a tremendous benefit. Some of the other low-cost financing down at the bottom of the page, that's not actually loans from the state of New York. That's private activity bond volume cap, which I'll talk about a little bit later on, but there's a limit on the amount of tax-exempt bonds that can be issued because it's a federal subsidy. The federal government allocates volume cap to each state, and then that volume cap, or the limit on the amount of bonds that can be issued, is then allocated to projects. So they include the volume cap allocation as being part of the regional awards, but it's not direct funding. I'll talk about the process for borrowing tax exempt later on. So that's a big picture on the different resources, the different programs that are available through the Economic Development Councils. So drilling down a little bit on the direct assistance last year, again, $240 million. One of the components is Empire State Development Programs, ESD, grants and other benefits. There's a significant amount that's available for grants, direct grants to businesses. And I have seen quite a bit of that. So money is there if you have a viable project. And then also part of it, the regional council process are the Excelsior tax credits. Those are awarded through the REDC program. The business incubator, that funding is for not-for-profits that actually operate incubators. And then $1 million for strategic planning. And then the Market New York, that's tourism businesses or tourism promotion. That money, for the most part, goes to municipalities and not-for-profits. So really from a manufacturer's perspective, that top line, the Empire State Development Grants, are really of most interest here. So the Empire State Development Grants, really, as you can see, it covers all components of a project. If you're going to be acquiring land or building or constructing, maybe demolishing something existing, capital expenditures, really. ESD grants are available for capital expenditures. And there are also grants are available for soft costs subject to a limit. And there's also some funding available for feasibility studies. The ESD grants are really focused on job creation, retention. Those are significant factors that are taken into account when the state and the local agencies evaluate projects for awards. Manufacturers are viewed favorably again because they're generally job creators and wealth creators. Usually you're selling your product outside the community, which is viewed as creating wealth for the community. So those are, again, positives. There typically would be a job commitment that goes along with it, often a 5-year commitment. If you indicate you want to be conservative in the number of jobs that you project, because there may be a recapture obligation, there typically is, or at least a right for the state to recapture benefits if you don't meet your employment projections. And so you don't want to have to return the funding. If there are reasonable explanations as to why you maybe didn't hit your targets, it's not automatic, but you don't want to fall into it and oversell and underdeliver. So that's something to keep in mind. So the Empire State Development Grants, they're intended to be an incentive to undertake the project. You really don't want to go too far with your project before you approach the state or approach your regional council, and before you actually are awarded whatever assistance you may receive. the cynic in me says it's because the governor wants to get the glory, and that is sometimes the case. I've seen that where we have projects ready to go, and we've just had to wait for the governor to come and stand on the podium. I hope I don't have anybody here that's government in any way, but in any event. But it's also because these are intended to be incentives. And if you've undertaken the project, you've started the project already, it's kind of a tough statement that, well, we wouldn't have done this but for the assistance. So you really want to minimize your investment before you approach your regional council and start the process to the extent you can. There are limits on the amount of the grants in relation to your project cost, typically 20%. There is some flexibility there. If you have a project that has a lot of support, frankly, if it's a major project, just about everything is negotiable. And so if the state wants it badly enough, they'll put together the resources. But for the normal process, your typical would be more than 20% of the grant. And they also want you to have skin in the game. So at least 10% of your own equity, and that means your equity, not borrowed money secured by your project. So that's another requirement for to receive the Empire State Development grants. But it is quite common, for the last 8 or 9 years, you'll hear in December, you read in the paper that various companies receive grants, financial assistance, and you say, well, what's that all about? It's part of this program here, the regional councils. Just going to make a quick reference, Excelsior Jobs, that's a tax credit program. Those tax credits are part of the direct assistance that's awarded through the councils. And Tom will talk about the details of the tax credits in a couple minutes. But they can also be awarded outside of the regional council process. But typically, it's part of the overall package. You'll see an award that includes a grant and tax credits. That would be your typical package, or very often package. So here are some samples of projects that receive Empire State grants and tax credits from last year in this particular region. There's a long list. If you go on to the regional council website, every grant recipient or aid recipient is listed. You see they range from relatively small, $65,000 to $2.4 million. And obviously that's a very large project in order to get that kind of grant, but there is funding available. And I selected just the manufacturing businesses. There are quite a few other industries that received grants during the last round last year. So the process, how do we get in on it? There's what's referred to as a consolidated funding application that it's an online application process that you describe your project, and by submitting that application, you become eligible for a wide variety of different programs, different types of assistance. As I mentioned, Power for Jobs or Recharge New York rather would be in there. So through the CFA process, you can put your name on the list for a variety of different state financial assistance, incentives, awards, etc. The applications are scored. There's a weighting system. At the local level, 20% of the weight is assigned at the local level, 80% is assigned at the state level. The local level, in part, is based on your project's relationship with a particular region strategic plan and any particular emphasis that they may have in the current year. So 20% local support is, that's a significant factor. So you want to work closely and have the local representative buy into your project, and that would go a long way. The CFA process, the timing for submitting your applications, this was last year. I checked yesterday, I didn't see a schedule for 2019 yet, but it's typically around the same time frame, same schedule. So you're able to start your application in May. They're due in summertime in July. And then the local councils have to finish their process, do their scoring by October, and then the awards are announced toward the end of the year. Certain programs, until the funds are completed, you're eligible to apply. But I would recommend, if you have a project that you're considering, that you get into the normal process. There's more resources available in that. First step, contact your local council representatives. Look them up, meet with them, explain what you have, explain your needs. They want to support your project. You know, there's regional councils, it's their goal to frankly get as much for their area as possible. And so you'll have an advocate for you. There are workshops that the state will have regarding consolidated funding application process and information. I received an email last week or a couple weeks ago. The Western region is now accepting letters of interest for this year. It's an optional process. It's just a way of getting out in front and starting the communication process earlier. And ESD is now out holding information sessions as well. So it's really, now is a time to start to take advantage of these programs if you have a project that's ripe, you know, and it may or may not be. It's certainly worth the discussion. And there's the website, and there's all sorts of other information. You go to the regional council website on the types of projects, your particular regions, areas of emphasis, strategic plan, etc. Representatives on your council. So I would urge you to go onto that website, click around, and there's a wealth of information there. So next I'm going to pass it over to Tom, who will talk a little bit about tax credits and other tax incentives that are available.
Thank you, Paul. So for the next 25 minutes or so, we'll take a look at New York state tax incentive programs. Particularly, we'll be looking at some credit programs and one particularly beneficial reduced rate available for manufacturers. Before getting into the details of the program, I thought it would be helpful to just pause for a moment and talk about exactly what a tax credit is and what a deduction is, how they differ. Everyone probably has an intuitive understanding, but it's helpful to work from a common playbook. So a credit, what is a tax credit? A credit is a dollar for dollar reduction in the amount of tax that you owe. So if you have a $100 tax liability and you have a $50 tax credit that you can apply against it, your $100 liability will be reduced by a full $50, leaving you with a remaining $50 liability. A deduction, in contrast, allows you to reduce the amount of income that you owe a tax liability on. So a $50 tax deduction won't reduce your taxes by $50, but it will reduce your taxes by whatever the rate is on that $50. So if it's a 6% rate, 6% New York rate, you'd reduce your tax by $3. So all things being equal, a tax credit is more powerful than a tax deduction. And more powerful still is what's called a refundable credit. So a refundable credit is one where if the credit reduces the tax you owe to less than zero, it's actually treated as an overpayment for New York state tax purposes. So same examples before, let's say you have a $50 tax liability and a $100 tax credit, that will reduce your tax liability to minus $50, and the New York state will cut you a check for that extra $50 that's treated as an overpayment. Now, it's worth noting here that while New York, by statute, will call your refundable tax credit a refund, effectively, the federal government and the IRS will look at that and apply what's called the substance over form analysis, and will say, you know, you're getting a refund. New York's calling it a refund for tax purposes, but from our perspective, if you never actually paid the tax in the first place, we're going to call that some kind of income. So it's actually taxable for federal tax purposes, your New York refundable state credits. So something to keep in mind when you're thinking about the after-tax value or the true economic value of a refundable credit. Think about tax affecting it, what it's really worth after federal taxes apply. It's worth noting there that most grants are also going to be treated as taxable income. Okay, so now let's take a look at a couple of the programs here. First one we're going to look at is the Excelsior Jobs program. The Excelsior Jobs program, the policy behind this program is to stimulate job creation and investment in New York's economy, and that's helpful as you think about what the requirements are for entry into the program as we get into that a bit later. It's a discretionary tax program, which means that although there are basic statutory requirements that you have to meet in order to be eligible to claim the credits, you also have to go through a review process and be admitted to the program by the Department of Economic Development before you can claim the credits. And we'll talk about that process, and Paul talked about it earlier. It's worth noting here that you're interfacing in being admitted to this program and in your annual checkups, which we'll talk about, with Empire State Development or Department of Economic Development, which are one and the same, and the Department of Tax and Finance. So this program is a replacement to an earlier program called the Empire Zones program, which was very popular and somewhat viewed eventually as a source of abuse, or where the state was providing more in terms of benefits than it was receiving in development. So some of the features of the Excelsior program reflect some of the perceived abuses, anyway, that were seen under the old program. So in particular, there's a cap on the total benefits that can be paid under the program. In 2019, that's $183 million to all participants in the program in the aggregate. Another feature that's reflective of concerns under the Empire Zones program is there's this annual check-in where you have to demonstrate that you've accomplished the things that you said you were going to accomplish in terms of investment and job creation each year that you're in the program. And there's also cost-benefit tests that you have to meet to show that you're actually, the state is realizing the return on its investment in terms of tax dollars that are being used to support the program. So what are the benefits of the Excelsior program? There are 4 tax credits that are potentially available, 3 that are available for all participants, and 1 that's only available for certain participants. The first one is a jobs tax credit, and that's a credit of 6.85% on gross wages paid to new jobs that are created after you're admitted into the program. There's an investment tax credit, which is equal to 2% of the tax basis of qualified property. There's a research and development credit, which is equal to 50% of the federal research and development credit, capped at 6% of research and development expenditures made in New York. That is an increase that came into effect in 2018 in the cap. And then there's also a real property tax credit, and that credit is only available to participants in the program that are regionally significant projects. We'll talk a little bit more about what that means in a few slides from now, or which are located in investment zones, which are certain economically distressed areas. So the way that credit works is it's a credit for 50% of real property taxes paid in the first year that you're in the program, and then that declines over the period that you are in the program, which, as mentioned here on the next slide, it's a 10-year benefit period. So once you're admitted into the program, you can claim benefits for 10 years. The program now ends in 2030. As of last year, 3 additional years were added to extend the life of the program, which previously expired in 2027. And these are fully refundable credits. So how does one qualify for the program? Separately, again, from the application process, you have to meet one of 3 optional ways to be able to participate. So the first is what's referred to as the job growth track. And this harkens back to the 2 things that the state was looking to stimulate with creating this program. In the job growth track, you have to either fall into a variety of strategic industry categories, and manufacturing is one of those strategic industry categories, and you have to meet a jobs target. For manufacturers, that jobs target is 5 minimum net new jobs that you have to create. That is also something that was liberalized a little bit since last year, which previously was 10 net new jobs for manufacturers. Per statute, the state is supposed to allocate 75% of the credits to job growth track applicants. So the idea is there's more of an emphasis on the creation of jobs than there is on investment, although investment certainly is still something they're looking to focus on. Who is a manufacturer? It's worth noting that manufacturing doesn't always mean the same thing for every program. I've got the definition from the Excelsior program here on the slide. You're talking about an entity or a business that's taking raw materials and transforming them into new products. It's worth noting here that it expressly excludes assembling existing components into new products, except for motor vehicles. But other than a motor vehicle manufacturer, unless if you're assembling new components, that won't qualify as manufacturing under the program. So if you're not able to meet the job growth track requirements, there's also an investment track option, and that requires at least a certain level of job retention. For a manufacturer, you have to maintain at least 5 full-time equivalent employees in your organization to be eligible. And then in addition to that, you have to make investments or new job creation that are 10 times the credits that you'll receive under the program. So it's a 10-to-1 cost-benefit ratio that you have to meet under the investment track option as a manufacturer. So the third option, if you're not qualifying under either of the foregoing, although you most likely would, is the regionally significant project. If you can fit into the regionally significant project, you can qualify for one of these. But this, as a manufacturer, would require you to create 10 net new jobs and also make a significant capital investment. And if you fall into this category, as I mentioned earlier, you're eligible for that real property tax credit, which other participants may not be able to achieve, which is a significant benefit. So assuming you can meet one of these requirements, how do you become admitted to the program? This is something you can do through the regional economic development councils, which Paul was discussing earlier. You would file that consolidated funding application, which Paul discussed. I have the link there to the website, which allows you to access that. The approval for admission is affected at the state level, but as you can see from the admission factors that are considered per regulation and statute, the recommendation of a local regional economic development council is an important factor for the state to take into account when considering whether to admit an applicant into the program. And you can see from the admission factors some of the same policy goals that were mentioned at the beginning. The creation of jobs, investment intensiveness are relevant to considering whether or not to admit an applicant into the program. You see some other policy goals of the state also reflected in the admission criteria. There's an emphasis on renovating contaminated, abandoned, or underutilized facilities, to use of energy efficient measures, being located in an economically distressed area. You see also this return on investment concept. The state is looking for projects that have financial viability to them, that look like they're going to be successful and produce a positive impact on the region. There's also a factor for consideration of preventing further deterioration, such as the likelihood that the applicant might relocate outside the state if the benefits are not received under the program. So once you've been admitted, you'll receive a certificate of eligibility and a preliminary schedule of benefits, and an estimate of what you would receive under the program. You also receive, I believe, the certificate of tax credit for the first year at that time, which is what allows you to actually claim the credits with your New York State tax returns. So each year after admission to the program, you have to show that you've achieved the investment and job requirements that you represented you would achieve when you applied to the program. So it's important to make sure that you're making representations that are sustainable and achievable as you come into the program. And you repeat this year after year. So each time you go to claim credits under the program, you need to have that certificate of tax credit from the Department of Economic Development to file along with your tax return. So this comes to an important general point about the care and feeding of tax credits. So when you're applying for these credits on the front end, you're dealing with your friendly neighborhood economic development office personnel, folks that are interested in getting you into the program. They're positive about your ability to get the benefits, and generally eager to work with you to help make everything work for the state and for the private interests. However, on the back end, when it's time to claim the credits, you're dealing with your New York State Department of Tax and Finance auditor, who is not necessarily as friendly as the person you deal with on the front end, which brings me to what I refer to as the tie doesn't go to the runner rule. The burden is on the taxpayer really to establish that they're eligible under the black letter strict rules that apply to the credit program in order to be eligible. This quote I have here is from a case which speaks directly to this point. It says, "A tax credit is a matter of legislative grace that must be narrowly construed. The taxpayer has the burden of establishing his entitlement to a particular credit, and the court may not allow equitable considerations to enter into the decision." So it doesn't matter that you've made the investment that the state wants you to make, or that you've generally been advancing the goals the state had in your activities in order to obtain the credits. You actually have to show compliance with every aspect and detail of the law to establish your eligibility. There's no room for courts or the tax department to say, well, hey, you're close enough. That's what we wanted to happen, so let's give you the credit. So the good news, though, is that with careful planning and thought about where the problems are, you can usually avoid pitfalls that will prevent you from obtaining credits within these programs. And the easiest, cheapest, and best way to avoid problems like this is to take a look at the tax return that you're going to need to file well in advance of the time where you actually are planning to file it, and go through it line by line and see what exactly am I going to need to represent 12 months from now, 6 months from now on this return to claim the credits. And that will put you in the right mindset and will help you avoid problems. Okay, so that takes us to the end of the Excelsior program. Now we'll take a look at the Brownfields program. Just doing a quick time check here. So in contrast to the Excelsior program, which was all about just spurring investment and creation of jobs, the Brownfields credit program, redevelopment credit program, is to try to get the goal is to get the private sector to clean up contaminated properties and develop them into new uses rather than to take undeveloped greenfields in the state and build manufacturing or other sites there. Here, your interfaces with the Department of Environmental Conservation as well as with the Department of Tax and Finance. There's also an application process required here. To the extent there's anybody from downstate New York City area listening in on the webinar today, just note that there are higher thresholds for participation in the program there, with the basic idea that not as much of an incentive is needed to redevelop properties in the New York City area because the economic value of those properties is so much higher relative to the cleanup costs. So if you go to research the Brownfields redevelopment tax credit program on the internet generally, you will find quickly that it's very confusing amount of information out there. And there's a variety of reasons for this, but one of the key reasons is that there are actually 3 different versions of the program that have existed since its creation. We sometimes refer to them as the old law, mid-law, and new law programs, or versions 1, 2, and 3. But you will find that there were different benefit levels and different rules and requirements for each phase. The reason it's still relevant to know this is that even though you can only get into the current version of the program, there are properties out there which were admitted under prior versions of the program for which there still may be benefits available, and I'll talk a little bit about that as we move forward. Another reason that the information surrounding the Brownfields program can be confusing is that the credits that are available vary based on the type of taxpayer, whether you're corporate or individual, where the site is located, how clean you make it. They're different. It's not like under the Excelsior program where you'd say, hey, there's a wage credit of 6.85%, everybody gets it. Here you'll see there's a wide variety in what kind of credits are available for whom and for doing what. This program is highly timing dependent. There are key milestones that you have to meet in order to be able to participate in the program. What costs are eligible to form the basis of credits in the program. We'll take a look at those time requirements and milestones now. So the first important thing that happens in this program is that you apply to the Department of Environmental Conservation for admission. And once you are accepted, you enter into what's called a brownfield cleanup agreement. So this is a very key event in the life cycle of this program, because you're only allowed credit for costs which are expended after you've signed a brownfield cleanup agreement. So it's important to keep an eye on timing and payments and issues like this from the very get-go before you even actually are admitted to the program, to make sure you get the most benefit out of it that you can. The next important milestone is the date that cleanup is completed, and this can take many years from the signing of a brownfield cleanup agreement, at which point you receive a certificate of completion, and this also commences a time period which defines when you can claim benefits under the program. This certificate of completion is an important document. From a non-tax perspective, it is a liability release. It adheres to the person who obtained this with respect to environmental contamination on the property, which is very valuable in and of its own right. And also the certificate of completion runs with the land, which means if land is sold, if there is a certificate of completion that was issued with respect to the property, the purchaser of that property can receive benefits through the Brownfield tax credit program with respect to that property. And the next important time milestone or date is the date that property is placed in service on a redeveloped site. So what are the benefits of the program? Primarily at this stage in the program's life, there are three components of the Brownfield redevelopment tax credit that have a lot of value for taxpayers. There's a site preparation credit, a groundwater remediation credit, and a tangible property credit. These credits are all calculated based on a formula, which involves taking an applicable percentage, which varies again depending on a lot of different factors, times the cost that the taxpayer has expended on the site, whether for cleanup purposes or redevelopment purposes, etc. There are a couple other benefits that are available under the program. Under earlier versions, there was an environmental insurance credit and a real property tax credit. They're not available under current versions of the program, or the current version, and they don't have as much economic significance, so we won't spend much time on those. The first two components of the redevelopment tax credit, the site prep and the groundwater remediation credit, really have generally much higher credit rates, between 22 to 50% of eligible costs, depending on how clean you get the property. As I mentioned, these are the costs that are eligible for claiming this credit have to be incurred after you've signed a brownfield cleanup agreement. And generally, these costs are capital costs that are necessary to investigate and remediate the cleanup of the property, to clean up groundwater that's located on the property, and also costs that are necessary to comply with the requirements of the certificate of completion in the 5-year period after the certificate of completion is issued. So the state gives a pretty heavy tax credit benefit for your cleanup costs, up to half the cost of the cleanup. The other credit component is the tangible property credit, and this is really the part of the credit that relates to encouraging the redevelopment of that property and the preparation of it and implementation of it for new uses. This applies to the cost of qualified tangible personal property that is placed in service within 120 months of the date of the certificate of completion's issuance. So you're talking about a 10-year period that you can use to claim benefits with respect to the new use of that property, and particularly for the building of new buildings or the substantial renovation of existing buildings. And I note that to the extent that you take a piece of property out of service that was used as the basis for a credit, whether it's because you're no longer using the site or there's a piece of equipment that's abandoned for some reason, there is actually a recapture requirement if you do so before the end of the useful life of the property. So this credit amount varies. It's a 10% base that any participant in the program can claim, 12% for franchise taxpayers. And there is an additional 5% credits available for property that's used for manufacturing sites. There are other factors that can also increase the benefit of that's available for this credit, including remediation to what's called track 1, or a very high level of cleanliness. For the tangible property credit component, that redevelopment component, there is a cap. So generally speaking, the amount of credit that's available for this credit is $35 million, or 3 times what your cleanup costs were. For manufacturers, there's a higher benefit at the lesser of $45 million, or 6 times cleanup costs. So they're trying to tie the amount of investment in the site and the credit that's available for that in some way to the cleanup costs, so that you don't have to do just, say, a small amount of cleanup in order to obtain very high levels of credit based on a heavily invested in new use. As mentioned, the benefits of the certificate of completion are transferable, so you could acquire property that has been cleaned up already, that has received a certificate of completion issued with respect to it, and claim benefits. Of course, you're tied into the existing benefit period, so if it's the 10th year after the certificate has been issued, you don't have a big window, but it's something to be aware of, and it may provide some benefit when you're thinking about maybe buying a property that has one of these. Something to note, falls under the category of the care and feeding of credits. Keep in mind, if you clean up a property and you've claimed some redevelopment credits with respect to the property, and someone else purchases it from you and then retires some property that you claim the credit on, you actually could experience a recapture event. So as with the Excelsior program, it pays to pay attention to all the small details that go into the returns and opportunities and traps to either maximize your benefits or surprisingly lose a benefit that you previously claimed. So that brings us to the end of the Brownfields program, and so we just have a little bit more time to talk about other New York tax incentives that are out there for manufacturers. So 2 significant benefits available for qualified New York manufacturers. One is a real property tax credit. The credit is equal to 20% of real property taxes paid during the taxable year. This is available to both franchise corporate taxpayers and individual taxpayers. For franchise taxpayers, there are no carry forward or refunds. It's not a refundable credit, unlike the Brownfields credit and the Excelsior credits. For a franchise taxpayer, this is not refundable, although it is refundable for individuals. However, there is also a 0% tax rate for manufacturers, which is available for franchise taxpayers, but is not currently available for individual taxpayers. There was a push to try to get it expanded to individual taxpayers last year, and this would include folks that are claiming credits on a pass-through entity's tax return, such as a partnership or an LLC. In order to claim this benefit, you have to meet the statutory definition of a manufacturer, as with the Excelsior program, and you have to have either all of your manufacturing property or $1 million of cost manufacturing property located in New York. The definition of a manufacturer for the purposes of claiming this credit is any taxpayer principally engaged in the production of goods by manufacturing. So we don't have as detailed of a definition as under the Excelsior program. It appears anyway at this point that a broader class of businesses could claim the credit compared to the Excelsior definition for a manufacturer. There's also a New York investment tax credit and employment incentive credit that are available that may be of benefit to manufacturers. This is a credit against franchise or personal income tax for property placed in service in a given year if the property is principally used in the production of goods. And this is clearly can apply to property that's used in manufacturing as well as other activities. This credit is 5% on the first $350 million of qualified investment and 4% on amounts in excess of that. And I note here that if you have an Excelsior credit, you have to choose which credit you're going to claim. Back up for a second. So for research and development property, there's an enhanced credit under the investment tax credit to 9%. If you claim that enhanced credit, you can't claim the employment incentive credit. And if you're claiming investment tax credit, you can claim up to a combined credit of 10% over the 3-year period. So there's a 15-year carry forward for this credit if you don't use it all in the current tax year. It will be refundable, but only if you meet a new business test, and it's a rather complicated test. If you have any kind of business history in New York, you have to watch carefully to make sure that you're satisfying this test. Again, as I mentioned earlier, if you are qualified for both the Excelsior investment tax credit and this production investment tax credit, you have to elect between the two credits, except for the case of property that's classified as research and development property. Generally, this New York investment tax credit outside the Excelsior program is larger, but as noted, unless you qualify as a new business, it's not refundable. So you have to look and figure out which one of these is going to actually yield me the greater benefit. And that brings me to the end of New York's incentives, and I'll turn it back over to Paul.
Great, thank you. I see there's a question or two down below. Let's pause right here and see. Oh boy. Oh, oops. Yeah.
A little technical.
Yeah, Tom, you got that?
There we go.
Okay. That's a little bit far out here. Bear with me here. Are New York State tax credits available to S Corp owners? Tom, you want to? So the question is whether New York State tax credits are available for S Corporation owners. Generally, they flow through. S Corps are pass-through entities like a partnership. So as a starting point, the answer would be yes. Then there are limitations on the amount of the credit that you can claim. But initially, the answer would be yes. So if you have an S Corp, those tax credits are available for S Corporation shareholders as well as limited liability company members. Oops, okay, I gotta go back here. Let's go back. I want to talk about local incentives now. So far, we've been discussing incentives, economic development incentives that are funded at the state level. Now I want to discuss Industrial Development Agency benefits, IDA benefits. I'm sure most of you are familiar with IDAs or have heard of them at least. Most counties have them, some towns have them as well. The mission of an IDA is to stimulate economic development. And so it's a pretty broad mandate. And manufacturing projects would be clearly, right in the wheelhouse of something that IDAs would want to help with. And IDAs can provide financial assistance for new construction, renovation, even if you just have a project where you're buying equipment, depending on, for manufacturers, you do have the sales tax exemption for production equipment. So and that's a statutory exemption that you get regardless of IDA involvement. But in some cases, if the equipment purchases are large enough, you may be eligible for IDA assistance for those as well. The IDA does go through a cost-benefit analysis before determining whether to accept a project, taking into account the jobs created, the amount invested, as well as the multiplier effect, typically, in relation to the cost to the state, i.e. the value of the tax benefits that are being given. So, and there's also, when evaluating whether your project would be appropriate for an IDA, there are some fees and expenses that go along with it. So there is kind of, it has to be a critical mass before you would go to the IDA for a project. I don't know if that's $1 million project, it depends, but smaller projects typically would not go through the IDA just because of the cost and that cost benefit approach. But again, if there is any question, reach out to your local IDA, talk to them about what you have, and see if it's might be something to be eligible for or interested in helping. So the benefits, the financial assistance, tax credits, or the tax exemptions you receive from an IDA would include exemption from sales tax on construction materials, steel, building materials, things like that, as well as any type of personal property that goes into the project, an exemption from the New York State mortgage recording tax, which I'll talk about in a second, partial real property tax exemption that's implemented through payment in lieu of tax agreement, as well as tax exempt financing. And we'll talk about each of those separately as we go along here. So looking at the sales tax exemption, it's available for project-related purchases. So furniture and equipment, construction materials, again, you already have for manufacturers a state exemption for production equipment. When you're looking at your project, trying to ballpark what you think the value of the sales tax exemption might be, in my experience, we typically look at and assume that 40% of your construction costs represent taxable materials. So then you would apply your local sales tax rate, say 8%, depending where you are, to that 40% of construction costs to try and ballpark the value of the IDA sales tax exemption for your construction materials. And then you would include any personal property that you might be including in the project. The sales tax exemption is only for a limited duration for project-related purchases, not ongoing operational purchases. Typically, when the IDA awards a sales tax exemption, it'll have a specific expiration date tied to the completion date of your project that you've described in your application when you applied for the benefits. And IDAs, in my experience, are willing to extend the sales tax exemption. You have to go back to them and request it. And as long as there's good reason, leave delays or whatnot. And now there's been a change in the law a couple of years ago where there's the amount of the sales tax exemption is specifically stated, and you're limited to that amount that's been stated in your award. So if you find that you're going to exceed it, go back to the IDA and request an additional approval for the increased amount. Because if you exceed it without getting that approval, you're at risk of perhaps having to repay the exemption. So you want to keep that in mind. Okay, so the mortgage recording tax exemption. In New York State, there's a tax that needs to be paid when mortgages are recorded. So if you have a project that you're financing with debt and there's a mortgage that secures the debt, when that mortgage is recorded, a tax needs to be paid. And in Onondaga County, actually the tax is 1% of the mortgage amount. However, IDAs, there's a portion of that, 25 basis points, that's not eligible for the IDA exemption. So the mortgage tax exemption is worth 0.75% in Onondaga County. That's of the mortgage amount. So pretty valuable exemption. It's kind of a hidden tax that a lot of businesses aren't aware of until you get to closing. The percentage varies by county by a little bit, but that's around the 1% range. And then IDAs can also provide a partial real property tax exemption through a payment in lieu of tax agreement. And that's implemented through what's referred to as a lease-back transaction. The company will lease the facility to the IDA, and by virtue of the IDA having a leasehold interest in the property, it comes off the tax roll, and then you enter into a contractual agreement to make payments in lieu of normal property taxes. Each IDA has its own tax exemption policies, referred to as the Uniform Tax Exemption Policy, or UTEP. I would encourage you to take a look at the IDA's website to see what their particular policy looks like. It might differ. It differs often depending on the type of project or any specifics. In Onondaga County, standard policy is your value of the improvements, the existing property that was there originally stays fully taxable, so nothing gets taken off the tax roll. It's just the taxes that would apply to the incremental value. For the first year, it's 100% exempt, and then it ramps down so that it becomes fully taxable in year 11. So that's typical. Sometimes they move in different increments. Again, Each IDA has its own policies and different types of programs. Finally, I want to talk about tax-exempt bond financing. It's a big area of my practice, but we don't see a lot of financing for manufacturing projects. I'll get to that in a minute. So, but certainly I would encourage everyone to take advantage of it if you can. Tax-exempt interest rates are typically 1% to 2% below taxable rates, so it can be significant over the life of the project. However, with the change in the tax law, the tax rate that's imposed on banks who typically would buy this debt has decreased from 35% to 21%. So tax-exempt interest is not quite as appealing to banks as it used to be. So I think the market is still in flux as to what the tax-exempt interest rate will be for this type of project. But there certainly is still a tax benefit, or rather a financial benefit through tax-exempt financing. The eligibility for tax-exempt financing is determined under the federal tax law, and there are a number of tax requirements that have to be met. The threshold for manufacturing projects has to qualify as a small manufacturing facility, which means there's a $10 million limit on the amount of the bond that you can borrow, but then also there's a $20 million capital expenditure limit. And that's measured during a 6-year period, looking back 3 years and then projecting forward 3 years. You have to expect at the time you close that you're not going to incur capital expenditures more than $20 million during that 6-year window in order to be eligible for tax-exempt financing for a manufacturing project. And that $20 million includes the amount that you're borrowing for the bond. So, and the reason is this is targeted to small manufacturing. They define small as a $10 million project by a manufacturer that expects $20 million of capital expenditures. If you issue the bond expecting that you're going to be within the $20 million limit, and then 2 years later something comes up and that changes and you exceed it, your bonds will be taxable going forward, prospectively from that date. Another requirement that I didn't go to on the slide is the project, the eligible costs, 75% of the costs have to be what's known as core manufacturing, your production floor, and no more than 25% of the financed amount can be ancillary facilities such as office, cafeterias, warehouse, etc. So 75% of the 10 million for core manufacturing, 25% for ancillary. That's another kind of threshold requirement when you look at your project. And typically what we do is we look at the floor plan of the project to see what's included and then try and quantify, because it's usually not priced out at that level, but do an allocation based on the floor plan as to how much of it's core versus ancillary. This comes up a lot. People sometimes think, well, the IDA is the one that's buying the bond. The money is coming from the IDA. Actually, no, they're just the conduit to allow you to have the federal income tax exemption. The bond is typically purchased by the company's normal lender. They go through a bank credit analysis. They would have collateral like any other type of loan, but it's structured as a bond issued by the IDA. In the past, banks would issue letters of credit rather than directly purchasing the bond. They would issue a letter of credit that secures the bond, and then the bond is offered out into the public market. That has kind of diminished over recent years. Letter of credit-backed bonds are not quite so popular, but that would give you access to a larger capital market. But now the norm would be that the bank buys the bond. But I wouldn't discount the possibility of letter of credit securing a wider offered bond. Here's an example of a project that I worked on a while back, not too long ago. It was a $13 million manufacturing project. They borrowed $10 million for it, and that's how the proceeds were allocated. numbers are rounded a little bit. There is a rule that says you can't use more than 2% of your bond proceeds to pay your bond issuance costs. So as you see, we've got $200,000 that was spent on issuance costs, and those can add up pretty quickly. The IDA, as issuer of the bonds, typically is paid a fee around 1%, sometimes 0.75, depends. Each IDA is different. So there's the allocation of the bond proceeds to a larger project. And then the overall benefits that this manufacturing project received, sales tax exemptions on construction materials and non-production equipment, the mortgage tax exemption, and then the pilot agreement. In fact, add that all up, and it was at $1 million of benefits from the IDA. They got the benefit of the reduced interest rate on their financing, and then also received an ESD grant for their project. So, altogether, $1.6 million on a $13 million project. It was, pretty helpful for this company. And that's all I have on IDA benefits.